All right, everyone. Welcome to the Retire on Purpose podcast. My name is Andrew Pallas. I'm a certified financial planner here at Minnick McGregor Wealth Management. And as always, we're joined by my co-host, my colleague, Cory Laird, another certified financial planner here.
Hey guys.
Today, we're going to be talking about some timely topics.
Yeah.
They seem to be timely because they've been something that we've been talking about, it seems, since April, right?
What's been going on since April?
I think there was this big announcement that happened on a specific day that was quoted as Liberation Day.
Liberation Day. Okay.
And it was the specific countries that would have specific tariffs
Yes.
that Trump was looking to impose on those countries.
So we're going to talk about current events, tariffs, leading the charge here in terms of the conversation.
Yep.
And what was the announcement made in April 2025? What was that?
The announcement as in
Yeah. What was the Liberation Day like?
Liberation Day was not, it was Liberation Day from your money. That's
Yeah,
that's
right.
that's the joke. That's the
Liberation
joke.
from your capital gains. That's right.
Yeah, I think it was, we experienced a lot more volatility during that period of time because there was a lot more uncertainty with what these tariffs were going to do, right?
Right.
So as we've seen, that was in April, and here we are in August. And, I think we've done some of the analysis to see that, when it came to April, the average tariff on the countries was what, Corey? It was
43%.
43%.
Yeah. That was the average tariff rate that was announced back in April.
So now we fast forward here today, in August, and what the average tariff rate now is
23%, starting, I guess, August 7th.
Yeah,
Right?
midnight last night. So
Yeah. So midnight, 2 nights ago.
2 nights ago.
Yeah. Yeah. Today's August 8th. Yeah.
Hard to keep
Yeah.
track of time. Days fly by.
Yeah.
Let's talk about maybe some of the financial impact in terms of maybe on the companies that these tariffs are affecting, or maybe the consumer. When it comes to the tariffs, who do you think the additional cost, because this will cost companies more? Do you think the companies will eat the cost, or do you think
Yeah, I think we have three potential parties here. We have three parties that are involved in terms of these costs. Most of the last 6 months with the 10% tariff base rate, the last 4 months that we've seen, I think a lot of that has been eaten by the companies that are being imported for the most part.
So would you say that's why we're not starting to see kind of the inflation data show that?
Yeah, I would say that's a big piece of it. You're not seeing that, but also you got to know that what else is going into the inflation data? Consumption. So if people are worried about these price increases, they're going to possibly decrease what they're consuming, and that alone, but decreasing the consumption will also decrease inflation itself.
So we have some things that are offsetting
Yeah,
one another.
yeah. 2 nights ago, we saw President Trump announce, right, I think it was right at midnight or something, right
Yeah.
on August 7th, midnight, that, these tariffs are now, introducing billions of dollars of revenue for the US government. Someone's paying for that. That's not just free money. That is coming from someone's pocket, and it's going to be the manufacturer of those goods. It's going to be the company that imports those goods, or it's going to be the consumer, in the end.
I mean, when it comes to, as an investor, it can make things confusing, right?
Yeah.
As a consumer, it can make things a little bit scary. Are we going to have to pay more for a certain product or a
Yeah,
certain
it's always
good?
in fear.
And I think we're starting to wait for some of that data to show up when, like you mentioned earlier, in the inflation side of things, because
Yep.
obviously if things become more expensive, if it's passed on to the consumer, that is essentially inflationary, right?
Yes.
So we've talked about tariffs, which tariffs potentially could lead to higher inflation, which higher inflation is exactly what the Fed is trying to fight. Is that right?
Yes. So you got to think about the Federal Reserve. It's always come back to the Federal Reserve, and it comes back inflation, because for the most part, the Fed was on a track to start to decrease rates last year, and they paused. I would assume they paused because they, like most of us, were fearful that these tariffs were going to increase inflation,
Yeah.
and that really did not occur, or for many reasons, but it did not occur. And now many people, including President Trump, has been, pounding on the table to decrease rates, to interest rates.
Yeah. We're starting to see some new faces in the FOMC, right?
Yep.
So that's something that we're starting to watch, because obviously if we do start to, for whatever reason, if interest rates start to decrease, right, that's going to be something that will affect the overall economy, right? So make things a little bit more cheaper in terms of debt.
Yeah. So, so interest rates, if interest rates decrease, if they decrease interest rates, that might entice you, me, that entice people to borrow more.
Mhm.
Because if the cost of borrowing is less expensive, then you're going to find more people to borrow more, and corporations doing the same thing. They might borrow more now that rates are a little bit less.
So we can see a decrease in interest rates as more of a stimulus to the overall economy.
Exactly. And I think that's really what Trump is trying to induce is to stimulate the economy by dropping rates.
Hmm.
But stimulation could also mean higher prices.
Hmm.
If there's more money out there, more cash out there, because I took a $20,000 loan, now I've got $20,000 and I spend that 20,000, it's going to inflate prices.
Yeah, inflate prices and continue to devalue the dollar, right? If there's too many dollars in the system.
That's right. Yeah.
So,
So if at the other side of the coin, if they increase interest rates, which no one really is talking about. Hopefully, they don't talk about it. But if they increase interest rates, then you got to think about the job market. If I'm a company and interest rates are going up, that's going to be more expensive. My debt's more expensive now. I got to cut costs somewhere, and that means I might have to lay people off.
mhm.
And so it's the job market or it's the inflation, and it's this balance that the Fed is trying to do. That if they increase interest rates or keep interest rates higher, then it's going to hurt job market. And if they lower interest rates, that might help the job market, but that might induce inflation.
Right.
And so this is something that they're concerned about quite a bit.
It's kind of a tightrope
It's a
that they have to
tightrope.
walk.
Yeah. Yeah, absolutely. The question is if if tariffs are ramping up, they have ramped up just now. I mean, just like yesterday, they went from a 10% base rate that most countries are paying to on average, we're seeing 23% now at this point.
Mhm.
So tariff have increased over the last couple of days, and you and before, Trump has rescinded those tariffs at the last moment, but he did not do that this time.
Mhm.
He's kept with it. So now the question is now that prices are higher, and so far companies have absorbed those costs, can they absorb another 13% on average?
Skeptical.
I'm skeptical
Yeah,
to say
yeah.
that they would do that, and you could argue that the reason why they absorbing the tariff so far is because of the uncertainty,
Mhm.
really the confusion of
Hoping
where
it's
the tariff.
temporary.
Exactly.
It's just something that'll
Yeah.
go by.
That they absorb it now. They don't want to increase their cost, increase their prices because they'll
Lose
lose
consumers.
market share.
Yeah.
Yeah. If I increase my prices 10%, but my competitor doesn't, I'm going to lose. People aren't going to buy my stuff. They're going to buy my competitor's stuff.
Mhm.
So losing market share is a big worry for them as well.
Of course.
It comes really down to inflation. If we see inflation, right now it's at 2.7 to 3%, depending on how you measure it. If we stay below that 3% inflation and future inflation prints, I think the Federal Reserve is going to decrease interest rates. I think they'd have to, specifically because the jobs reports that we got last week and the weeks before have showed certainly a slowdown in hiring.
Very contentious job reporting.
I would say very good interest
Very
indeed.
contentious job.
Yes.
Someone lost their job over that job before.
But the Federal Reserve has put their flag into the reason why we aren't decreasing interest rates is one, we're worried about the tariffs, increasing inflation, and two, the jobs are great. Why would we decrease rates? Why would we need to do that?
Yeah, I mean, it definitely is causing a lot of drama in DC at this point between
It
what to
is.
do and who's
Yes.
going to be in position of power, shadow chairs, the Treasury talking. It's a lot of moving parts when it comes to that.
And you got to know that the Federal Reserve is considered an independent agency, not just by law, it's also an independent agency in terms of trust. The international community, the U.S. Investor, they trust that the Federal Reserve has the mandate of jobs or inflation or keeping these under control. The mandate isn't to just stimulate the U.S. economy. That's not one of their mandates.
Right.
But if we get somebody who's not worried about the jobs or worried about inflation, but they're worried about stimulating the economy, that might sound good in the short term, but
Mhm.
it might cost us with higher prices if they're not worried about inflation, or a job market that's getting rattled if they're not worried about the job
Yeah, I
market.
mean, because we have, inflation that potentially could be driven by tariffs, but then you have something called monetary inflation, which is driven by too many dollars in the system,
Yeah.
right? Devaluing the dollar, and that can cause inflation as well.
Yeah.
So it is a fine line of, not doing too much too quickly, which is Jerome has been very cautious and, making any changes. So, but
It comes down to that inflation number. If we see inflation sub 3, we're good to go. If we see inflation go above 4%, we might start talking stagflation at that point.
Yes, it's a scary word.
It's a scary word. So you have very little growth, job market sucks, and you have high inflation. So if the Federal Reserve increases interest rates, it makes the job market even worse. If they if they increase interest rates, it makes the job market even worse. If they decrease interest rates, it makes inflation even worse. So what do? Stagflation is one of those things that there's not a lot of answers to.
Yeah, I mean, we've seen it before. I mean, the U.S. economy has seen stagflation back in 1980s,
1970s and 80s,
1970,
yeah.
yeah. So,
And I don't think anybody looks back at those times as a great time to invest
well, I
or
mean, the way that they got
stock
out of it is they
market.
had to throw us into a recession.
They
So
did.
it's
They had to force a recession to do it. Yeah.
so again, these are all the areas that we're watching. As we get closer to the end of 2025. That wraps up today's podcast, today's series of Retire on Purpose. If there's anything that you're specifically looking to or looking forward to for 2025, feel free to comment below. If you like what we had to say, if you feel that someone could benefit from these videos, please like, subscribe, and share. Other than that, we will see you on the next episode.
Thanks, guys. Appreciate it.